Very good morning, everybody, and a warm welcome to all of you on this Saturday morning. First of all, I would like to thank each and every one of you for making the time and showing your presence on our webinars regularly. Thank you very much for that. And so today, as you can see, we have come up with the topic of how to manage your loans and liabilities on a Saturday morning when everybody wants to relax. So our idea is to help you understand few aspects of managing your loans and liabilities and how you can make a better choice and informed decision and ease a little bit of your debt burdens with this session. So this is going to be a more of a general sessions with some specific topics where we will be touching upon to bring a different side of the debt aspects. In case you have, any specific queries regards to your debt management, we can have it at the end of the session. So let's begin. So when we think about credit and debt and loans and liabilities, can we see or imagine a life without credit in today's world? I don't think so, because credit has become an important part of our lives. We want it or we don't want it, credit is an inevitable part. So we remember, when we were young and small children, our parents used to, have a small book with a round the corner grocery shop wala, right? So we used to buy groceries on credit every month from him. I come from a very, middle class family. At that time, we can say a lower middle class. So that was the easy means of getting a credit at that point of time. So every now and then we used to go with that book to the shop and buy whatever we needed for the household. And the shopkeeper used to write it down and with the price and all. And every month end he used to make a bill, and my father used to pay the bill at the end of the month. So we had this system for a very long time. So after a few years, when our financial situations improved and we had liquidity, my father had liquidity, but still that had become like a normal thing for us to take things on credit because it just made life so simple. Because every time he need not have to keep cash at home and ensure that my mother also didn't have to think that she doesn't have cash, and if she needed anything she could just go with the book and get the things and things like that. So what I'm trying to say is it is a easy, it makes our life easy to a certain extent, right? So most of the times people are contradicting this point. They say that living without credit or without debt is the best thing. So those are some extreme or you can say specific situations where that is possible for them. But for most of the households today, living without credit or living without a loan is kind of impossible. So we can look at buying a phone or a washing machine or a fridge today, even though we feel that why to unnecessarily shell out a lump sum where we can get a no cost EMI or a very small EMI which we can pay off in 6 months or 8 months or a year's time, right? So it makes things easy. So in today's world, we cannot think of a life without loans, credits, right? So it also helps our economy, the country's economic growth. Not only India, globally, credit and debt has become, a very important part of the overall economic growth. Countries lend themselves, among each others. So even countries borrow. So this is like helping each other out and making the most of financial facilities that we have, right? So how it has progressed over the years, I have just picked up some points from a survey or a report which was done by ENY recently, a few months back. So in that report, what it says is, over the years, the bank's ability to provide credit has improved. Because every now and then there has been a lot of regulations and lot of tweakings and improvements coming to the system where the bank's NPAs have also decreased. Now we can see that even though there are some defaults here and there by banks and complete closure or take over by another bank, but that has considerably reduced in the past few years, right? So NPAs have declined and regulatory oversight has improved. The banks, the RBI has come up with a lot of recapitalization, mechanisms where insolvency is reduced, to a larger extent. So all this is making way for a better, banking system, a better credit system, right, in the country. The mortgage market is expected to grow considerably. It is expected to double in over the next 5 years. That is given the backdrop of increasing levels of economy, people constantly working towards a better living, lifestyle. So each and everyone, you see today's in today's, world, every household is, striving to give their children a better education. They don't want their children to struggle as much they did. So you can see all these small vendors also, sending their children to good schools and education. So over a period of time, so that's what their parents also did, right? So over a period of time, everybody on an average, if you see the average household income of, individuals per month, it is improving drastically in the last 10 years. The awareness is good. They want to have a better economic, situation, financial situation, lifestyle. Uh, it's more to do with the system that, the government is providing them, and how to make use of them. So all this, when we see, they, whenever there is a need for a loan, so getting a loan itself was a, kind of a long dream, we can say, for small vendors, right? Because of the digital infrastructure and the constant struggle that they do to improve their financial, financial stability, right? So the digital infrastructure in a way has given them a new life, right? Because of these transactions, now they have a better records to show, and basis that, where banks are also coming forward and willing to give them loans, small loans, big loans for small businesses, vendors. It's becoming easy for them to get a loan with all this infrastructure. So showing all of this, the credit, market, the debt market is going to grow and improve because of this widespread financial inclusion. Okay, so this has, unleashed the potential to access credit, underwrite risk, and establish recovery mechanisms also, reducing the friction in distributing credit. So distributing of credit has also become a very easy and a doable thing these days in the banking system, in the overall economy. So this is about the economic growth. So what we are trying to draw is that credit will be a part of the system, has been a part of the system for over a long period of time. It will be a part of the system, going forward also. Now, what for us as individuals in personal finance is important is the, what is the first thing that comes to an individual when, taking a loan, right? So the thing is, a good credit score. Credit score is very, very important to get a loan that we desire on our terms and conditions, a low interest loan. So credit score becomes a very important thing. So that is one of the important indicators of one's financial health also. So it makes getting a loan easy. So why do banks and other financial institutions look for a credit score? See, if you date back to the earlier times when, these small vendors or people who are not having any, records of income or irregular income, and they wanted to take a loan, usually they used to go with the hand loan kind of a thing. And there were some people who used to, I don't know what they're called, they're like, creditors per se, who used to take the interest on a weekly basis. For example, if I lend you 5,000 rupees every month, every week you have to give me 500 rupees. So that was like an arrangement. So that used to be very, very expensive. But those were the small time lenders that, that used to earn big time, and they were available every now and then. I remember my maid also, taking help of these debtors, or, to take the hand loans, or loan from relatives where there was no interest, and people used to pay them back and things like that, right? So that is how it has come. Now what has happened is, because of banks and NBFCs and financial institutions more willing to give loans, credit score becomes a very important aspect, because it gives them a report to assess who are their potential customers, and what are the risks involved, when they are giving out credits, and how is the recovery expected, right? And what, because end of the day, it is business for them. So their cash flows, their business cash flows are also important for them to survive, right? So all these credit scores matters to them also. Now, how can you get your credit score low? That means, how can you maintain your credit score better, right? So what are, so everybody knows that if you make timely payments, and if you close your loan on time, so all this will help you get a good CIBIL score. But what are those things which will impact your CIBIL score are more important to understand, right? So when you use credit cards, right, everybody uses credit cards these days, right? So for every small payments, for small payments, for petrol, for booking air tickets, booking hotels, we use credit cards, and there are a lot of offers also given on these credit cards. The idea is to keep people using this credit system, so that the organizations can make their money. But for an individual, it becomes important to understand at what level should we use these credit cards, or these small loans, and how do we make the most, so that our credit scores are not impacted, our cash flows are not impacted. So today's session is more on that. So what is the awareness that one should have when we are using these things? Late or missed payments. So whenever you miss a payment on a credit card, your interest will shoot up. That again has a negative marking on your overall credit score. So what is the best way to do is, a lot of them might be doing as well. So they schedule their, payments on a particular date. They give standing instructions and schedule their payments, so that payments are not missed. Because someone who is regularly using credit card will do this as a norm by scheduling payments. So, what is the payment schedule? Like, how much uh, should be scheduled as a monthly payment? So that also we will see, what is the ideal way to do it. Second important thing is, how much of your credit limit on your credit card should you be using, right? Can I use everything of it? The answer is no. So you should always use within the credit limit that is there on your card. Okay, so that is because you have to keep some buffer for the interest, or for the the charges that are there. So you should keep some buffer for that as well. So ideally, it is always recommended that you shouldn't exceed 30% of your overall credit limit. To be in a better credit score. So overshooting your credit limit also gives a negative impact on your credit score, CIBIL score, right? So what happens is, when there is a revolving debt, a revolving credit card debt, what happens is most of them, they go and transfer their credit card balances to other cards. So all these are easy to do, but in the long term, you don't know that these are impacting your overall credit score, right? So the next one is negative account information, repossessions, foreclosures, your charge-offs and bankruptcy, or anything that is showing that you are not managing your liabilities properly. The money that you owe to people, you're not managing them properly, gives a negative credit score for sure. Another important, which many a times people forget, is several having several loans. Okay, just I don't know, but sometimes I see that we come across a lot of financial plans, and when we are assessing the financial situations, this is one thing that comes as a pain point. It hurts to see that there are multiple loans taken, and we don't see a reason why these were done. So the reason is either to get a better lifestyle. It could be out of fascination that I want to have best of everything. Living within means is also something which people tend to ignore over a period of time, when they feel that they're able to take care of the EMI payments, the credit card minimum payments, and hence they take loan and EMIs and things like that, for every little thing, and there are, suddenly they see that they are in a debt trap. And these things are like a very very negative, or caution points for anybody to look at. So several loan applications in a short period of time. This also impacts your credit score. So why is that? It may give an impression that somebody is in desperate need of money, or it is very unorganized, or without planning somebody is doing it, right? So these are some things which one should be aware of. So next, you should understand what are those warning signs that you might be building a crisis. So it might not appear to you that things are taking things are looking bad, but over a period of time they'll start building up. And you should every now and then you should have some checks and balances to look at where you stand today and where is it going, right? So what are these? So minimum payments on credit cards. So you should always it's always easy to look at what is the minimum payment that is required every month, and it's very normal that people just pay that much, and rest will continue as a credit. But what will how this will impact is, so this will impact by increasing your interest payments overall, right? Minimum payments are just a way for the just a way to make you be in debt for a longer period of time. As simple as that. You would have the suggestion is, if you have payments on your credit cards, it is always better to pay off and close it, because credit card rate of interest are quite high, and any misses that happen, it again impacts your credit score, and it will also the heavy interest will be charged, and default charges will be charged on that, right? So the what are the thumb rules? The thumb rule is that your minimum payments should not exceed 15% of your take home salary. So if your minimum payments required, uh, if they're exceeding 15% of your take home salary, it means that there is a much more debt, more than these minimum payments that you are required to service, right? So and you will soon be in a mode to just keep on making these minimum payments without having a plan to repay the rest of the amount possibilities, right? So another important indicator that you might be getting in a debt trap is that you are constantly or frequently transferring your balances or refinancing from one credit card to another, right? So these are all indicators of this thing, building a debt crisis. Another important thing is, when you do your financial plan and when you observe that you are required to stop your savings, your PF contributions, your SIPs, or it could be anything. You are required to stop those and increase your EMI payments. That is a red signal. You should really think, where this is heading and for how long this will go on, and how long this will be the situation, and how these decisions are going to impact your overall financial plan, your children's education, maybe your house purchase goal, or your retirement goal per se, right? When your savings are reducing and your payments are increasing, that is a red flag for you. So you should start relooking at things and have a more organized approach. Second, the another important thing is, when you have set aside some money for any important milestone or a goal, right? And because of debt servicing pressure, you are required to pull out from those funds and repay your loan. That is another red signal, which um, any advisor will tell you not to do it or not to get into a situation like that, right? So those are some of the checkpoints which will tell you a lot about where things are heading and what you should be doing. Last but very important is lack of a budget. So whenever things are just going like on the flow, right? Uh, it all indicates that there's no plan, there's no budget. So it is always good to have a budget and start. If not, if things are looking a little bit on a danger side or on a way to danger side, you should create a budget and see what is best to be done. So one important thumb rule I would like to give here is, for any household, your total expenses plus your EMIs should not exceed 40% of your take home salary. So this is like your checkpoint. So this again varies from individual to individual and household to household and age wise also. Somebody who is in the age group of 35 to 45 years old, who is in a stage of having their own home. So home loan will be a bigger part of their overall EMIs. So in these cases, there can be little deviations, plus or minus 5% to 10%. But overall, this is like a thumb rule. So you should really gauge in what age and what stage of financial situation you are, and take have a relook and reassess your things from every now and then. Now let us look at a case study. So we have Mr. A here, who is 44 years old. His oldest child is 10 years old and youngest child is 1 year old. So they have a monthly income of about 1.9 lakhs, and another rental income is there, so around 10 lakhs, 10,000. So total monthly income is around 2 lakhs. This is net income, in hand income that is coming into the family. Monthly expenses are to the tune of 1.35 lakhs, and savings are going into SIPs, RD, and there's an insurance policy. So total is coming to around 55K of monthly savings that committedly that is happening. After all this, so the monthly surplus is just about 10K. So now, in this monthly expense of 1.35 lakhs is also the EMI that is there. Okay, so we'll just see what are the assets and liabilities. They have a lot of real estate property. Three properties are there. One is the rental property, where that rental income of 10K is coming, 35 lakhs. There's a small piece of land of 10 lakhs. It's a small piece of land in the hometown or village, I don't know. So inherited property is there, that currently parents are living. Shares and mutual funds of about 25 lakhs, and there is a FD of 2 lakhs. Total loan outstanding is 20 lakhs. Now, this loan, how it is structured is, there's a loan against property of 1.3 lakhs, and rest all is multiple gold loans of different tenures, like 1.6, 1.7. So all put together, it's around 18.7 lakhs of gold loan. So they have pledged the gold and taken a loan. So monthly expenses include this EMI of 65,000 per month. So in that 1.35, 65 is 65K is the EMI that is going, right? So what are the financial goals of the family? So first priority is the loan closure, then the two children's education, then retirement planning is there, purchase. They also want to have a house of their own in the city they are living, which is expected to be around 70 lakhs, and they want to do it in this year itself. New car, vacation goal, and they have gifting also as a goal. Niece, there are about 2 to 3 nieces. One is immediate in the short term in 2024, and two more in the long term in 2031, in about 6 to 7 years. They have to plan for another two nieces gift for their marriage. So goals can be anything. So the idea is to how to prioritize, and what is your current financial situation at this point of time. What is it that you can prioritize over the next 4 to 5 years? So all this planning, revolves around that. So the gross savings required for all these goals, if he or she has to achieve, if this family has to achieve all these goals, then the monthly savings that would be needed to achieve all of this will be around 7 lakhs. Given the different time horizons, inflation at the rate of 7%, and return on investments at the rate of 10%, right? So currently, the committed savings that is happening into SIPs and the RD and the insurance is around 80,000 rupees. So there is a huge gap of around 6 to 6.5 lakhs per month, right? So in this situation, so this is how it looks. So in the short term, within a year, there is a big big requirement of loan closure and niece's gift that is coming, and flat goal is also there. So within a year, given the current financial situation, it is hardly, it's very impossible to imagine how to pull off these things, right? Then slowly we have vacation, then children's education. So in the next, the first child's education is going to come in another 7 to 8 years. So that is that. New car and niece's gift is there, and the longest goal is the retirement and second child's education, which is both coming in the same year. So now, what are the pain points of this financial plan? Is that there are multiple loans and which are scattered over a very different periods of time. So one is 3 year, one is 5 year. The EMIs are also different. One is 7 year. So there's no clarity on the cash flows and how to structure it in a more organized way. um, the family feels that we are doing the savings also, so we think we are in a good situation, but whatever they are doing is not enough for the kind of goals they have coming in, right? So then the another pain point that we see is that there is lack of liquidity and contingency fund also. So everything that is coming into the family is going into some or the other buckets. There is no liquidity. So the only liquidity is there, that is the FD of 2 lakhs, which is there. So contingency fund, if you see their overall expenses plus EMIs, they should have at least 7 to 8 lakhs as emergency fund. If God forbid there is a situation of layoff or anything like that, they need liquidity, right? Next, what we saw is the lack of goal-based planning. So they are saving, but it is not targeted saving. Like I always keep saying, in my webinars, like investing without a goal is like shooting in the dark. So similar thing has happened here. They are saving. I'm not denying that they are saving, but then there is no plan. What are we saving? How much is required for my short-term goals? And how much I should be saving for that? How much is required for my long-term goals? And how much am I doing? So that approach is missing here, right? So we can see that there is overload in real estate, and the real estate is also like not giving them enough cash flows or enough income that they can pull off the long-term and medium-term goals. And insurance, so there's lack of insurance also. This family has a term insurance. The breadwinner of the family has a term insurance of about 40 to 50 lakhs, which is not enough given the two children's education, and wife is not working. So if her living and the debt and everything has to be considered, then at least 1 to 1.5 crores of life insurance is required. The cash flows are looking very tight, right? So there's no way to do anything more than what they're doing today. It appears like that. Nothing can be done. So this is what it is, and because the cash flows are very tight, so there's a very high need for goal prioritization. Then what is the solution for them? So the first thing that we suggested is to consolidate the loans. So, what is loan consolidation? I'll explain in a bit, but it just means that taking a loan of the total, his total loans today are about 20 lakhs, right? So, he can go for another loan of 20 lakhs, which can pay off all these loans, and that EMI can be serviced. So, usually, when the loans are consolidated, the EMIs and rate of interest will reduce considerably. So, that is the idea of debt consolidation. So this will help him organize his cash flows to a certain extent. He'll have better visibility of the cash flows, right? So that is the suggestion. Next, what he can do is the piece of land that is there. It's a very small piece of land, and it is currently it's like a dead asset for him because it is not giving him any cash flows. And currently, looking at the situation, it is better that he puts that money in some high yielding investments for the long term goals like children's education. So the idea is to sell that piece of land and use it for his medium or long term goals. The RD that he's doing, right? Some 10 or 15,000 of RD he is doing. So RD interest rate is not great. We all know how it is. So best is to stop these RDs and divert it into SIPs. In that also, we have to structure it in such a way that one portion of it goes as an emergency fund creation, where there is accumulation in that fund and it can be used. It can be kept in a liquid fund or something, and he can use it for his emergency. Simultaneously, his other a few other goals can be taken care, like children's education. Right. The flat purchase goal in the current city needs to be deferred for some time till the loan is sorted, right? So once this loan is sorted, they will get a better cash flow, and this can be planned. And this will also buy him some time to plan for the down payments. right? So we have asked him to defer the flat purchase goal for some time, and meanwhile he can plan also, and later he can look at funding this by selling off the rental property partially, or whether loan can be taken. In a few years, there will be a lot of clarity regarding his promotion, his other cash flows also. So for the time being, let us push this for some period forward. Consolidate the properties over a period of time. So the rental yields are also not great, right? Given the city, anywhere if you see it is between 2 to 3%. Of course, it's a good source of passive income, but again we have to go by the financial situation and what we want. Whether we want to have debt free and a easy life, because maintenance of property, rental yield is not great, right? There's cost involved, and rental incomes are again taxable. So, considering all that, for a situation like this, it is better to consolidate all the properties in a few years and have a good, self-occupied property and prepare other financial assets for passive income. So, that is what was the suggestion given. Now, let us look at a way, where you can consolidate your debt. If you have multiple high interest loans, the best way is to consolidate them with a new loan to pay off the older ones and have a more structured, payment mechanism. So, what are the advantages? Is one single set of recurring payments that are easier to manage, a clearer timeline of when you can be debt free, and greater control of your budget and cash flow. So, these are the advantages of debt consolidation. So, if you go out to any banks today, some banks provide something called as a debt consolidation loan itself. So, then what they will do, they will see what are your existing outstanding liabilities, and they will sanction a loan for the total amount of debt, and they will make the payment directly to the to the other banks. In this case, in Mr. A's case, the gold loan will be directly paid off by the bank. So these are called debt consolidation, loans. In some banks, what they do is they suggest you to go for a personal loan of the value of the existing, loans that you have, and you pay off. So there can be multiple things. You just have to see which one works for you. So who should consider debt consolidation? So as a similar case like Mr. A's, where there are multiple debts, finding it hard to manage them, and cash flows are not looking good. The interest rates are high. There's no clarity of timeline, right? So a difficulty in maintaining the monthly payments. So everything is so unorganized, it feels sometimes, right? So in these cases, you can always look at debt consolidation. So going back to Mr. A's case, what will happen if he consolidates his debt now, right? So his current multiple loans are outstanding loan is about 20 lakhs, and his EMI is coming to 65, little more than 65,000 per month. Now, when he consolidates his loan, let's say with a personal loan, let's say, for example, if he takes a 20 lakhs loan today, personal loan with 11%, the personal loan, no interest rate is in that range. So if he takes 11% rate of interest loan, his EMI comes to, for a period of 5 years. So on an average, so these loans are spread across 3 years, 5 years, and 7 years. So when I hit the middle ground and say, let's say 4 to 5 years is what I want to do. So 45K per month is what is coming as a EMI. So he will be saving another 20K per month with this strategy. So they can do that. So that was the case study. So if you have any questions on this, we can have it at the end of the session. Now let's look at what are some of the common questions that we as advisors get on loans. So these are very common questions. Even if you Google today, you will have so many articles around these questions, right? So which loan should I close first? Somebody who has been in this, somebody who is of 40, 45, 50 years of age knows, with my very much clarity that which loan should be closed first. How much loan can I afford is another question that we get asked. How should I use my windfall money? If somebody who doesn't know what is windfall money, it is just any money that comes all of a sudden, like like a bonus, or like a gift by somebody, or inheritance coming in cash, or something like that, which comes as a windfall money, or some profits of some land, sale of land, or profits from shares or something like that. So suddenly, when there is money coming in, we don't know how to best use it. So, how should I use my windfall money? Is one another important question. And with respect to loans itself, like should I pay my loan or should I invest it somewhere? So we get asked these type of questions. Another important questions that we get asked is should I increase my SIPs or should I increase my EMI? So we look at all these questions. And lastly, but very importantly, how can I protect my family financially when I have a big loan? Right. So, which loan should you pay off first? So, this is a very common sense kind of a thing, but often it gets when somebody is in a financial situation, these things can be very daunting and overwhelming. So, there is lack of clarity. So, when you consult an advisor, which loan should you pay off first? The first thing that anybody will tell you that you should pay off the loan which is of higher interest rate, so that you are saving interest, which a loan which doesn't have any tax benefits, like personal loan or a car loan, right? These do not give you any tax benefits. The only two loans which give you tax benefits are your home loan and your education loan. Then there are fixed interest rate loans. If interest rates of in the economy are falling, you should pay off this fixed rate loan first, right? There would be penalty, but the interest saved and the opportunity cost will be much higher, which will compensate for the penalty that you're paying today. It will make your life and your financial situation much better, right? Coming to the rate of interest, I would like to give away one point here. So whenever there is a change of rate on loans, the banks will not come themselves and communicate that there is a change in the rate of interest, especially if it is a reduced rate of interest. So most of the times I have dealt with like 4 to 5 customers of mine who are not aware that there has been a rate cut. They were still paying on the same EMI and same interest, right? So it is important to be aware of the rate changes, currently, and go to the bank and submit a application to do the rate change for your outstanding loan balance. So sometimes what happens, there is also a benchmark rate getting changed. For example, now recently HDFC Limited got acquired by HDFC Bank, right? So the benchmark rates that we use for providing loans will change, right? So there's MIBOR and LIBOR. There are different lending rates that the banks follow. So those will change. So when there is a change, are the customers communicated? Should I upfront go and talk to the manager or talk to my RM and get this change? Is something you have to look at, and this will save you a lot of money if it is a reduced interest, right? Prepay the loan on a depreciating asset. So, what are your depreciating assets? The assets which are not increasing in value and which are in turn having costs to maintain them. Very common one is the vehicle loan, right? It is not an asset; it is a depreciating asset, right? In case of financial distress, this asset will not fetch you much, so it will keep on reducing in its value. So these are the assets where you have taken the loan, you should pay them first. So now let's look at an example, right? Where one second. Sorry, yeah. So let's look at a comparison of home loan, education loan, personal loan, and car loan. These are the outstanding amounts, and the loan tenure is 5 years each. Now, if anyone wants to decide which loan should I pay off first, then this is the assessment you should be doing. So let's say the interest rates are 10%, 13, 14, and 11%, and these are the EMIs, respective EMIs of the loans. First, put down the actual things that is running right now. And what is the penalty for the prepayments? So personal loans and car loans usually have a penalty for the prepayments, usually in the range of 1 to 2%, right? So what is the prepayment amount that you're considering to prepay? Right? Let's say in this case, it is 5 lakhs, 5 lakhs, 5 lakhs. So what is the new EMI going to be? So this is another point that we should be discussing, is whether you should reduce your EMI or reduce your tenure. I will come to that point after this discussion, but let's say now we are going to go for an option of reducing the EMIs. So what will be the savings in EMIs after this prepayment is done, and after the prepayment charges, the reduced EMI? What are the savings that I'm going to get? So 10,011 So these are the amounts that will be the difference in the amount that I'm going to save. Excuse me, give me a minute. Sorry about that. So what are my total EMI savings? Are these amounts. So as you can see, the total EMI savings is highest in the case of personal loan, right? What are the tax benefits that I'm foregoing? With this amount that I'm going to prepay, the tax benefit is going to reduce for me for that much or that many years. So what is that? So that is the amount. So when we see the net savings that has happened, with this idea of prepayment for all these four types of loans, you can see that the highest savings is happening in the case of personal loan, even after paying the prepayment penalty, right? So in that case, you'll start numbering, ranking them, and the first you should pay off is your personal loan, then your car loan, then education, and lastly the home loan because of the tax benefits, right? So now coming to the question of whether you should increase your EMI or decrease your tenure. So always a financial advisor will suggest you that it is always best to keep your EMIs the same so that you're already committed to that much of an amount. In the case of, especially in the case of a home loan, right? So it is better to pay it off and reduce your overall tenure so that you can focus on other goals. Anyway, that much of commitment is going. It is always better to pay higher EMI and close the loan faster. By reducing the EMI, the bank will always want to keep you in debt for a longer period of time. It is for their benefit, of course, because it's a business. But for you as an individual, it will always work to increase your payments because one wants to get out of debt faster, and home loans are a very very long term debts, so it will always help to get out of it faster. Now, how should I use my windfall money? So whenever there's lump sum money coming in, one thing is given that you should not let it sit idle for a very long time in savings account because that is not earning you anything. So how do you decide? So first thing is you should see whether you have enough emergency fund. So first, if you have pulled out from that emergency fund for some emergency recently, then you have to replenish that first. Secondly, you have to check on your term and health insurance. If it is adequately taken, many years ago, and if your assessment is coming correctly for the term insurance. How do you assess your term insurance requirement? By the way, you have to consider what your children's education, what your children will need for their education if something happens to you today. What is the total amount of loan outstanding as on today? What will your wife need or your spouse need for the rest of the life in case of your absence today? So all these three are the important things which will help you assess the what is the term insurance that you need. Another alternative way to do is, we all know a thumb rule: 10 times of your annual earnings should be your term insurance, right? So first assess that whether you have adequate term insurance or health insurance or accidental insurance. If you don't have adequate cover of these, then use some part of that windfall money to have these in place first. Next is revisit your financial plan. Look at which goals need, uh, you know, what is your goal status? Are your monthly savings taking care of those goals over the longer period of time? Then you don't have to touch them, let that go. You can, pump it up a little bit by putting some lump sum in each bucket of those. Another thing, that you can consider is, see, someone who wants to get out of debt faster will always choose to go and close that debt so that there's nothing wrong in that. Some people also do that, but some people always weigh the pros and cons and think that if I put it in investments that will earn me a higher rate of interest, my goals will be taken care. I have my risk management techniques of home loan insurance, and my family is protected and I can take care of my loans. So it's a different thing for different people. So paying off high interest loans will be the next priority. And again, you can take up investment also based on your risk appetite. Now, should I invest or repay the loan? How do you decide? what you should do with your lump sum money. So the best part is to check your solvency ratio. What is your solvency ratio? It is simply put, it is the worth of your assets. Okay, the worth of your total assets, which can take care of your liabilities in one shot if something happens to you, right? So how do you assess the solvency ratio? Is you have to calculate your net worth and divide it by your total assets. What is the net worth? The net worth is nothing but your total assets minus your total liabilities. Assets minus liabilities is your net worth. Divide that with total assets. So this will give you your solvency ratio. Solvency ratio should always be higher, more than 80%, more than 90%. So then it means that you have enough assets and your debt is in adequate levels, is on correct levels, and you're not overboard with debt. So if something happens to you, your assets are there to take care of your loans. So there's a deeper analysis when we do term insurance analysis, right? We also consider your assets that can come to your rescue in case something happens to you, and the net whatever remains is the balance amount of insurance that you will need. So that is that is called human life value assessment, where we also consider all these things, right? So depending on what you want to achieve, whether you want to become debt free or whether you want to strike a balance between investments and debt repayments, it all depends on what you want at the end of the day. Because investing and paying off debt are two different sides altogether, and both have their own benefits, right? Investing gives you a higher corpus for your goal. Paying off debt, eases your financial stress and burden. So both are equally important for any individual and family. So striking a balance or taking an informed approach is very important, right? So it has to do with the age that you're in, what is your risk appetite, what are your goals, how well you are placed with your goals, and how well you are placed with your debt servicing capability, and then take these important decisions. Now let's look at a small working where I can show you how your is how you can take advantage of increasing your EMIs, right? So what will happen if you increase your EMIs? So let's say there's an individual who has taken a 1 crore of loan and interest. Let's say this is a home loan, right? What is the interest rate? It's around 9%. Let's say the tenure chosen is 15 years. EMI is coming to about 1,01,000, right? So this is the loan amortization table. So now in a normal course of time, this loan will go on until 15 years, right? So until 15 years, if it goes, the total interest that this individual will be paying is around 82.5 lakhs, right? So the total payment will come to 1.82 crores, right?
Ma'am, just to, sorry to interrupt you, we are not able to see this.
You're not able to see the Excel sheet, is it? One second.
Yeah, please share.
Yeah, is it visible now, Sanjay? Thanks for letting me know. Yeah.
Yes, ma'am, it's visible.
It's visible, right? So yeah. So this is a 1 crore loan amount, 9% rate of interest, 15 years is a loan tenure, EMI is around 1 lakh, right? So if in a normal course of time, this loan will go on till 15 years, like I was saying. So the total interest that he will pay will be around 82 lakhs, 82.5 lakhs, and principal amount is 1 crore. So total he will be paying around 1.82 crores, to the bank. Now let's say he is in a position to make a little bit of additional payments after a year. Okay, let's say he wants to increase his EMIs in the 13th month. He wants to increase his EMI by 20,000 rupees. Okay, so what will happen after this point of time? He increases his EMIs by 20,000 rupees. So his loan will come down drastically. Okay, so his loan will come down to 143 or 144 months instead of 180 months, right? So what is it like? So he will be closing the loan in about 12 years instead of 15 years by just making this 20,000 of extra EMIs. So in this case, what will happen is this will be considered as, sorry, I have missed. Okay, so this will be considered as the payment towards principal amount. Whatever extra EMIs you will be paying will be considered as your portion of your principal amount. So it's not 144 months. It's actually, it will come down to 133 months. So 133 is nothing but, let's say 135 months. It's nothing but 11 or 10 years. In 10 years, he'll be finishing off the loan with just 20,000 of extra EMIs that he's going to pay. Right? So what is the total interest with the reduced tenure that he'll be paying this? Okay, so the interest will come to 59 lakhs 96,000, or let's say 60,000. Okay, so 60 lakhs. So savings on interest is 22 lakhs. So you have to choose, how you want to prepay your loan. So prepaying the loan is a technique, or rather, you have to understand it a little deeper, and then pay off increase your EMIs and pay off your loan faster, right? So this will help you improve your cash flows down the line. You'll get out of debt faster. You'll have time to look at other important things, right? So how should I prepay this? How much should I prepay, right? So if it is advisable. It's a thumb rule that at least 5% of your loan balance you should prepay every year. Every year, at least 5% extra you should prepay, right? You can go faster or slower based on the availability of cash and your situation, your financial situation, and what you want to achieve. When to prepay your home loan? This is very important. So if you can see in this loan amortization table, I'll just share it again. Yeah. So if you see in the loan amortization table, so the interest in the initial years is a lot more, right? So in the initial years, the interest will be a bigger component than your principal payment. As you go paying, the interest component will come down and your principal component will increase. So it is ideal to always, do the prepayments in the initial part of the loan and not at the end of the loan. So if you really want to plan a prepayment, always do it at the beginning of the loan tenure. So start planning. So what are we trying to draw here is you have to start planning from the initial itself. Like even before you take a loan, you should have a plan. How do you want to repay it? You should understand your cash flows even before you get into a loan, right? So prepayment in the initial years will make a lot of difference to your interest payments and will save you a lot of money, down the line. So we have already seen the loan amortization table. You should always consider if there is a penalty on your home loan. So after 6 months, ideally in a home loan, there will not be any penalty. So after 6 to 8 months, you can plan your prepayments and close your home loan faster. Pre-closure of personal loans, as I was mentioning in that table, they have pre-closure charges which are a little bit higher, right? But still, you have to choose and pay off these loans, because net of these charges also you are better off in the long run, because it will save you a lot of interest, it improves your credit scores, and your cash flows are better, right? Now, coming to the question, I have a very, very big loan and how do I protect my family? Most of the times, the answer is not most of the times, the only answer is the home loan protection insurance, or the alternative to this is your term insurance, right? What is the difference? Home loan protection insurance and a term insurance. There is a difference, because in a term insurance, what happens? Only if there is a death, then the payout will be given. But there are scenarios which will also lead, which an individual is having a risk. Let's say there's a accident, or there's a disability, or there's a critical illness which comes into the picture, or if there is a layoff, then who will pay the EMIs for the period when one is not employed. So all these situations are more likely to happen than death. Death also, it's uncertain, but given the situations, like most of us travel by car these days, right? So there could be an accident, there could be a partial disability, there could be a permanent disability, which will hamper your incomes into the family, which are taking care of your EMI. So what to do in these situations? So you should have a comprehensive home loan protection insurance, assessing the kind of situation you are in and what are the possible risks that you are facing in your day-to-day life. That if something happens to you, will impact your EMI payments, will put the burden on your family members, if something happens to you. So having a home loan protection insurance, if you have a very, very big loan, then it always makes sense. Sometimes banks push for this home loan protection insurance, saying that is compulsory. If you don't take this, we'll not disperse you the main loan. It is not like that, because as per RBI, there is no compulsion. It is always at the discretion of the home loan takers. But from a financial planning perspective, from a long-term perspective, it is always better to have these risk management tools to protect your family and your loved ones, and your overall finances also in the long term, because home loans are a very, very long term commitments, right? You never know what will happen. We don't know what will happen tomorrow itself, right? So in that case, it is always better to protect our family with the home loan protection insurance. So there are a lot of permutations and combinations that insurance providers are also giving these days. It will take some time, maybe 3 to 4 months time, to for you to understand what you need, and they coming up with a quotation and you are okay with that. It can be attached to your home loan, and they will make they'll add this the full premium amount to your loan, and increase your EMIs a little bit. This will be on a reducing balance method, but it is totally worth it if you want to protect your family with a big home loan. So there are a lot of questions you might be having, but I will take it up at the end of the session. Now, how to avoid getting into a deep debt? So the first, if you look at the 7 steps to success that I've put there, so it always starts with a plan. Always have a plan, what you want to do with your finances, rather than doing it just go with the flow kind of a approach. You should always have a plan, a deadline. Self-discipline is must, self-control, focus, and your systems and the actions that you're taking, it all matters. So the first and foremost thing is prioritization. So you should prioritize your needs over wants. So that will give a lot of clarity what you should go for. Understand your budget, your household budget. Plan for emergencies, plan for contingencies, plan for your life insurance, health insurance, risk management, right? Use your credit card wisely, right? And I have already explained how do you make payments and minimums, and what are the thumb rules that you should be aware of, and what actions you take on your credit cards, how will it impact your overall CIBIL score, right? So we have dealt with all that. So do not have more than 2 loans at a time. Ideally, from a financial planning perspective, don't go for more than 2 loans at a time. So this will put you in a revolving debt kind of a thing, and it is a lot of stress, that you will start feeling down the line. So always, set up a plan and then do what is right for you. So these are the key takeaways of our today's session. But before that, just take a look at the right side, some motivational picture that I have put. So it's the steps that we take every day matter. So every day, the things that we do is different. Sometimes it is on a higher level, sometimes some days are low, some days are high. But down the line, it will be worth it, and we should always believe that yes, we can do what is right for us. So draw up a budget and plan, number one. Second is stick to your solvency ratio. Look at your solvency ratio from time to time, and ensure that it is more than 75 to 80% of the overall assets. Pay off your high interest loan first, depreciating loans, and make sure you have adequate insurances, whatever insurances you feel you need, whether it is critical illness, whether it is a normal health insurance, whether it is a proper term plan, accidental insurance, permanent or partial disability insurance, or a home loan protection insurance. Whatever it is you feel you are at a risk of, these things, have adequate insurances for yourself. Emergency fund is a must. have at least 6 to 8 months of your expenses plus EMIs as an emergency fund at any point of time. Even if you take out from it, replenish it from time to time and ensure that it is always there. Use your credit card smartly and always plan big spends beforehand. If there is a big spend coming, it should always be planned. That is the best way we can do it, right? So that's all for today's session. So if you need any help, with managing debt and want to do a comprehensive financial planning and understand where you stand today, you can always contact me on my number, or any queries for that matter, you can always get in touch with. Thank you, everyone. I hope you all like the session, and thank you very much for your participation and patience. And we can take some questions now.
Thank you so much, ma'am. Thank you for sharing valuable insights. We're already having few questions in the chat box and Q&A section.
Yeah.
So, you want me to read it out, or you can
Yeah,
take the
I'll
questions?
take it, Sanjay. Thank you very much. I
Thank
just
you.
overshot the session by a few minutes, but I hope that's fine with everyone. I'll just take a few questions and then we can go. Um, okay. There's a question by Mike. Okay, I already have 2 flats and planning to take a luxurious one, which would cost 1.3 CR, excluding interest. Not yet finalized, but would like to know would it be a right decision? My monthly cash flow in current scenario is 2.5 lakhs. One flat is on rental income, another property is a commercial property under construction. Mike, we need a few more details to tell you exactly, how you should go about this. Maybe we can connect, after this session. I'll give you a call. Please drop your number. I'll give you a call after this session, right? So, if you have a small salary, Mr. Ravi Mirji is asking, if you have a small salary and you're also investing, then minimum payment for credit card payment is viable. If salary does not increase and you want to continue investing, can I still make minimum payment for credit card? Yes. So there are different scenarios, like minimum payment for credit card. You can continue with that, but why are you using the credit card is my first question. So is it that there is a liquidity issue? For what aspects you are using your credit cards? So those, again, I go back to that basic question where I showed in my key takeaways, whether it's a need or a want. So again, you have to go by prioritizing. All right. So using first step is using your credit card for what, whether it is for day-to-day expenses, or sometimes we end up using a credit card for groceries also, right? So what is it? It's always better to pay it off if you are especially if you're having a small salary and you feel your income is not going to increase. Then the best way is to avoid credit card altogether. Try and restrict using cash and closing it off then and there instead of going on a revolving credit basis. So that's my opinion. But if there is more to that, I'm happy to connect, offline and take it further and explain you in much more detail. In UAE, I think Jeevan is asking, in UAE, everyday credit card provider is giving loan. Is it a wise decision to take loan from UAE and investing in Indian bank provide better returns? I'm not sure what are the terms and conditions from the UAE credit card, Mr. Jeevan. More details. I would need more details for this. Like, what are the terms and conditions? What is the interest they are charging? What will be the trade-off for you? And if you are repatriating that money to India, whether repatriation is possible, and all, we have to consider a lot of things, in this scenario. As of now, I cannot answer that question, but there is more information that I would need. Mr. Gopal Parekh is saying, I don't have any loans. Still, they say your credit score is less as you don't have any loan. See, yeah, exactly. So, if is it that you have never taken a loan in your life? So that should not impact your credit score, by the way. But I'm not sure. So I'll get back to you on this, like why it is showing as a less credit score. I need to check with my sources, like what could be the reasons, and I'll get back to you. Yeah. Sanjay, can we have this, the records of these questions so that we can get back to them?
Yeah, yeah, sure.
Yeah, because I don't have first-hand information and I don't want to give a wrong information. So I'll recheck my answers and I'll get back. Yeah. Okay, that was from the chat box. There are a couple of questions in the question box also. Okay. Mr. Madhusudan is asking, new P2P lending is much talked about and projected as a new business model, promising double-digit returns of 12 to 13% yield. This is based on difference of lending at high 18% personal loan and then paying 12 to 13% interest to investors. How do you see this new model getting popular now? So peer-to-peer lending, yes, it has become very popular, but it is of a high risk because peer-to-peer lending is usually given to businesses which are like upcoming, right? So there's a lot of risk involved, and that is why the returns are higher. So my suggestion is one should get into such kind of financial arrangement. If I'm assuming you're talking from a lending perspective for a return, right? So if your financial goals are taken care, and if you have surplus money where you can take that risk and play around a little bit to see how it works, then I think it's good. But for a layman and for a person who is planning goals at this stage and has a lot of dependence, this would not this is not an ideal thing because it comes with a high risk, right? So yeah, that's my answer. Closing of credit card loan or personal loan, which has to be a priority? Mr. Lakshmikant has asked this question. Always go by closing your credit card first because there are a lot of charges that will come if you do not pay them, and it's like if you don't schedule your payments, any misses that will lead to credit, and there is a higher chance of getting in revolving credit with the credit card loan. So better to close that first and then move to personal loan. Yeah. So I think I've answered most of the questions. Um, yeah, I'll take a last one. Can I make my insurance premiums on my credit cards? See, a lot of people use credit cards for different things, Mr. Sasi, right? So it depends. See, if you, what is the what is the purpose or what is the objective you want to do this? Is my next question, right? So the reason could be you don't have liquidity, that is why you're doing, and this is an investment. So to make this investment, which is an insurance premium, and that insurance policy is earning you how much? Around 5%, 6%. For that, you're using your credit card. What is the interest on your credit card? So I don't feel that's a good situation. But if there is a cash crunch or you need liquidity for some other important thing, once in a while you can do that, but please don't make it a habit, to do insurance premiums with a credit card. Of course, you get points and things like that. But like I was saying, the whole idea of the system is to keep the persons longer in the debt so that the businesses are making money. So it is a facility which is making our life easy, but we should really understand smartly, like when we should use the thing and for what. That's my opinion. If you have more to discuss, I'm happy to connect.